Okay, recording this video after close trade, Wednesday, 30th of March 2016. I hope you've had a good couple of days trading. Monday was pretty quiet, obviously, after a long weekend. And on Tuesday, we were just waiting for Janet Yellen to speak. We were very quiet until the minute she opened her mouth, and then bingo, we ripped to the upside because everybody thinks the central bank has everything under control. And we think Janet Yellen is going to keep us all safely tucked up in our beds. There's going to be blue skies and sunshine forever and ever and ever. And we'll never have a down market, never have a correction or a crash because the central bank has our back. Thank you, Janet. One day, Mother Nature will reassert herself and we'll have an almighty crash, but not until the central banks have been seen to be the false prophets that they are. But anyway, you got to go with what you got to go. I miss the good old days. I miss pre-07, 08 when we cared about earnings. We cared about global GDP growth and US GDP growth, and we listened to what Caterpillar had to say about global growth and 3M about industrial growth. No one cares about earnings anymore. No one cares about corporates. It's just whatever the central bank says is going to happen next. Everybody's listening, reading between the lines. It's just up and away until the day when it's not. Anyway, let's not talk about that anymore. I want to talk about the bond market. And I'll have one chart I'll show you on the equities market at the end of the video. But really, just want to talk about the bond market because there's some handy-dandy stuff on the site. One of which is a little momentum indicator which shows us overbought and oversold regions in the equities market. One way of using that is to look at the yen versus the equities market, and the other way is to look at the bond market versus the equity market. Now this is the little handy-dandy chart that you normally see. This is the SPY, which is the ETF for the equities market, and FXY, which is the yen ETF. You compare the momentum in the two of these, and when they start moving diametrically opposite, you get oversold and overbought regions. Oversold and overbought. And this is the little indicator that kind of shows us those regions of oversold and overbought. And it's just looking at the relative momentum. As money rushes into the equities market and as the yen is weakening, that's kind of good for supporting the carry trade. And then it reverses as the yen starts to strengthen. The equities market can sell off because the carry trade is unwinding. But that same little chart where we look at the rushes in and out of the equities market versus the bond market has stopped working over the last several weeks. And remember, the reason why we're putting these ETFs on the same chart is because TradeStation does not allow us to mix symbols with different delays. So if you've got different exchanges or different time zones going on, TradeStation will not allow you to plot two symbols on the same chart. They can be in different charts in the same window, that's no problem, but you can't do intermarket analysis by using an indicator that's referring to data 1 and data 2 lines in a chart because they won't plot like this. I mean, this is a throwback to TradeStation's kind of early days when they didn't want signals being generated by a symbol in a different time zone generating a trade in your time zone. So if you like, you couldn't look into the future to get a signal to trade on in your time frame. So they made this pretty harsh rule about not mixing symbols in different time zones and exchanges. I think multi-charts is better at mixing symbols like this, but in TradeStation it's always a little bit of a problem for us. And the reason why this chart has stopped working is because of this. If you go to Bloomberg, we can see BlackRock has moved their primary listing for 11 ETFs off the New York Stock Exchange, Arca Exchange, and they've moved it to, well, in the case of TLT, they've moved it to the NASDAQ. So nice of them to do that. It's fair enough. They say they're doing it because they want to keep competition between the different exchanges. Fair enough. That's their prerogative. Don't mind you doing that, but it has kind of messed up my chart, which I kind of don't like. So what are we going to do to fix this? We now have to look for an alternate ETF that is tracking the long-term bond market, just like the TLT, but is in the Arca exchange. So this is the TLT, and you can see we've got that's now moved on to the NASDAQ exchange, and it's 20-year plus kind of bond markets following this Barclays bond index for long-term treasuries. We got a couple of different choices. We've got TLO and EDV. TLO is, who does this one? This is the spider. following the Barclays one, and then EDV, which is the Vanguard ETF, doing the same thing. We've also got VGLT, but this, unfortunately, this is the Vanguard one, but it's on NASDAQ. You can see there on the exchange there, so that you'll have the same problems using VGLT as TLT, so we can't use that one. So we're left with TLO and EDV. Unfortunately, you can see that the price pattern, the price chart between each of these is very tight, very similar. But the volume is vastly different. The TLT is highly traded, liquid kind of ETF. You've got millions of contracts traded every day. You can see here it's 8.5 million contracts traded today on TLT compared to 100,000 on TLO and 100,000 on EDV. So it is not as liquid as TLT, which is a shame. But at least the price pattern kind of matches, and that's what you're looking at. You're looking at the various difference in the momentum of one index versus the other. So for whatever reason, I think TLO is probably a good stand-in instead of TLT. So we're going to swap that over on this bond chart. I'll show you what happens. So we go format symbol, and we're going to change TLT. We're going to format that, and instead of TLT, we're going to put TLO and close that up. And bingo, there we go. TLO data kind of flows in, and all of a sudden we can plot the SPY versus the TLO, and all's good. And again, you can see oversold markets, overbought markets. So in the last move, beginning of the year, we were oversold. The money started rushing into the bond market out of the equities market. And then it's rushed into the bond market. So we've got an oversold situation here where the money had been flowing into bonds and out of equities, and we tipple to one side of the boat and we start moving the other way, and the money rushes into equities and out of bonds. And so over the last month or so, we've had some weakness in the bond market, which has now started to catch. In the last few days, we've had a little bit of support in the bond market, and the equities market is reaching overbought levels up here. So you can see that spike there on all these white bars. So that's kind of neat, and we got this chart back working again, which is good. The other chart that I like looking at from time to time is a comparison of the different types of bonds, and you might want to set this up on your charts here. So here I'm using 4 different symbols, 2 comparing the kind of government side of things and 2 comparing the corporate side of things. So the TLT, which I'm going to swap in a second to TLO, that's the treasury market, and then the MUB, which is the muni bond market. So you got the federal side of things with treasury market, treasury bonds, versus the municipal bonds, so kind of the more local government side of things. You got 2 sides of government there. Then on the corporate side, you've got LQD, which is the investment grade corporate bonds. That's the good stuff, the AAA type stuff, versus the HYG, which is the high yield corporate bond stuff. So that's what we typically refer to as junk bonds. So you got the 2 sides of government and you got the 2 sides of corporate there. So I'm going to just swap this over from TLT to TLO and then close up that chart. And bingo, we're back to a working chart again. The reason why I like looking at this chart is you can just see the strength in the different bond markets kind of going on. I'm kind of like Martin Armstrong's take on this. You can see that 07, 08 was the market kind of sold off, and we've had strength in the bond market kind of ever since, but the strongest part of the bond market has been in the government treasury side of things. So you can see that's this is the TLO in green, and that's the stuff that's been going up. So TLO or TLT, that's been the strongest of the lot. The weakest of the lot has been HYG, which is the high yield stuff, the junk bond stuff from corporates. So it's some strength since 09, but it's started to weaken in the last couple of years. Municipals, again, they've been fairly strong. I think after the correction 07, 08, a lot of financial advisors were saying you can't go wrong with munis because they get a kind of tax benefit and put your money in that instead of equities. And so there's been quite a lot of kind of play into that, but the strongest of the lot has been the move into the government bond side of things instead of the municipal bond side of things. Martin Armstrong is the view is that at some point we'll have a sovereign debt crisis, we'll have a lack of confidence in the government bond side of things, and instead the money will flow from government bonds into corporate bonds, and particularly the high investment grade stuff, the LQG, high liquidity investment grade bonds. And you can see that, over the last several weeks since the beginning of the year, yes, we've had quite a lot of strength into that investment grade corporate bond market. But it's early days. We've not seen the government bond market kind of reach a top quite yet. We're still in an uptrend. I'm just going to show you that here. This is the multiple time frame view of US, which is the 30-year government bond market, and this is going back a few years since 2014. We broke into an uptrend here. That's all the red bars going up, and we found an exhaustion place. We got exhaustion by bearish divergence, and then a whole bunch of end of trend signals kind of go off, and we fall off into this downtrend. So the beginning of 2015 we had weakness in the government bond market, and we kind of had rising rates. And then since then we found support. So mid last year we found support here. Cyclical support kind of comes in on the highest time frame, and we've started to break into an uptrend since the end of last year, and this is these red bars that have taken us into this uptrend here. And then over the last few days, we've been caught by this little support, cyclical support kind of gone in, and we've had a little bit of an end of trend gone there, but that's early days. That is just on the lowest time frame. We're still above resistance on both the intermediate time frame and the highest time frame here, so we're still in an uptrend. We've got to see kind of blow off volume and so on in the bond market for it turning around. So I'm guessing that we're going to break through this at some point and kind of continue this uptrend. So we've got this strength kind of going on. Remember, it's the end of the month. It's the end of the quarter kind of going on. So we've got still got some equity flows kind of going on to play out. But I'm wondering if we're going to get this downtrend in the equity markets kind of set off after that. I showed you this chart on the weekend, and when I showed you it, we'd had this really strong day. Let me just show you. This is the daily breaks. So this is Wednesday's trade. This is Yellen speaking out of a congestion move here. We got a breakout, bang, into this uptrend. And this was the quiet Monday, and this is the Thursday beforehand. And so we'd started to sell off because we'd had these nice exhaustion buys, bearish divergence, cyclical resistance kind of comes in. We start to sell off here, and then we get a move back up. And I was saying, with this move back up, is that the professional money kind of just gaming it and then looking for a better entry point in order to drive it down? Well, we started to break into this downtrend down here, but then this is the day that Janet Yellen spoke, and we had this little cluster going on here. This is a gathering pattern, blue professional bars just waiting for that breakout into an uptrend, and bang, that thing that just took off. Remember, that was happening around 10:30, 11 a.m. That's 11 a.m. in the morning. If we've not reversed by 11 a.m. in the morning, that is going to be the trend for the day, and that's exactly what happened. We just kept on busting stops up and up and up. If we're out of the window for a reversal, the highest likelihood is that we're just going to keep on busting through the highs, and we were just busting stops the whole day on Tuesday all the way up. And then once you get a day like that, a high range day, the next day you're going to expect it's going to be a lower range day, which is what we had today. I think it was only 13 points kind of top to bottom. And on days like that, start to play the cyclical turns on the 4500 tip bar chart, kind of backwards and forwards. Resistance, support, resistance, around support, resistance, and so on. So don't expect kind of a big trending break. So what have we done on this highest time frame? On this highest time frame, we put in pullback to end of trend, exhaustion buy, bearish divergence, and flush pattern here, but it's on the lowest time frame. We've still got to make pullback to end of trend on the intermediate time frame, so that's what's playing out at the moment. And then because we're through resistance on the highest time frame, we're likely to, that's going to be an important level going forward. So as we play into this end of month, end of quarter, look for those flows to run out after the first day or two of the month, and that's what's going to be interesting. To did this signal that we've just played out into another kind of exhaustion pattern, into another kind of big downtrending move? The bond market is looking stronger. The equities market is starting to top out kind of here, but I thought this was topping out and we were going to reverse and go the other way. But no, Miss Yellen had to speak, and we had to hear what the central banker had to say. Anyway, so there we go. Move your bond charts, if you're following these, from TLT to TLO, and everything will start to work again. So that's what I've done over the last day or so, and everything's looking pretty and fine. Hope your trading's going well, and looking forward to the next couple of days.